It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. I'm going to discuss some things about real estate here initially because there's been a lot of articles and a lot of things happening in that market I think you should be aware of. It turns out that 70% of the U.S. households cannot afford a $400,000 home, which happens to be a little bit below median average price for a home in the United States currently. Unfortunately, for over 94 million households in the United States, the basic milestone of purchasing the average house is slipping out of reach. This means the majority of the population finds itself priced out, even of a typical home. To comfortably afford a $400,000 house, a household now needs to earn an annual income of over $110,000, and that's assuming a mortgage rate of around 6% and a 10% down payment. Currently, mortgage interest rates are well above the 6% mark and are closer to the 7% mark as we speak. And that's for somebody with good credit. And if you take this even further, houses around the $200,000 mark, which is half the median average, require a $61,000 household income, and over 50 million households in America do not meet that income requirement. Unfortunately, the American dream of owning a home is turning into a nightmare of perpetual renting for many people and financial instability for tens of millions of citizens. The causes are inventory shortages in some areas and higher mortgage rates than what we have seen for most of the past decade plus. The reason I'm bringing this up is one of the questions I've been receiving from clients, listeners, etc. is, should I buy a home right now? The answer is it truly depends. Part of it is where you are looking to purchase. Different markets are performing differently. Real estate is famous for location, location, location. The Southeast are seeing some of the biggest price drops, particularly Florida. Other areas are not, particularly the Northeast. But there's no doubt that housing affordability is at some of the worst levels on record. In other words, it's never been more expensive to purchase a home since they've been tracking the numbers. And this goes back literally decades. Shockingly, in over 230 U.S. cities now, 1 million is only enough for a starter home. And what Zillow defines as a starter home is a home that's in the bottom third of prices. This points out how dramatically homes have increased in some markets. And unfortunately, we're seeing some people, when people are asking, is it time to buy a home? They're saying home prices are not coming down. Well, the statistics are painting another story. In fact, currently 60 markets across the U.S. are seeing falling home prices amid the housing crisis. Also, many home sellers are now offering concessions because of the slowing housing market, and we have not seen these levels since the Great Recession. In fact, over 44% of homes for sale in the past month have offered some type of incentive or concession, seller's concession. This highlights how tough some of the markets have become for sellers. Zillow has also predicted that prices overall for housing would decline somewhat for 2025. And this is rather historic because it's very rare that housing prices actually go down. But given the historic rise in housing over the last few years, it's almost natural that prices are going to come down somewhat, particularly in those markets where inventory and availability has increased. In previous shows, I've also highlighted and shared where many wealthier individuals have purchased second homes, oftentimes at vacation homes, sometimes as rentals, strictly for the appreciation. They rode the value of the properties on the way up. That has changed. And many of these people that own these second homes are now looking to sell. In fact, according to Zillow, their prediction of seeing housing prices reduce overall would be the first time the prices would fall since the great financial crisis of 2008, 2009. Their prediction is home prices will fall about 2% this year overall average. Certainly, some markets are going to see much greater than that, and some will see less than that. Some will actually see some increases. Again, it's all about the location and availability of inventory. That's the biggest criteria or determination for this. So, to answer the question, should you buy a home now? It really comes down to this. If you need to purchase a home because of a job change, for example, or something along that line, you really don't have much option in terms of purchasing. So, you're just going to have to bite the bullet, most likely, and move forward on that. But if you can afford to wait, housing affordability has never been worse. It's unlikely in most markets that prices are going to go up much, if at all. It's far more likely in many markets, again, where the availability of housing has increased, the inventory has increased, we'll see some drops, some reductions. So, my advice comes down to it depends on your situation, certainly, and the market you're looking in. But for most people, waiting is probably the better option if that option is on the table, if they can afford to wait. Another reason why I bring this up is there's a lot of uncertainty in the economy. There's a lot of volatility. We've discussed on this show for the last several weeks many of the tariff policies, which has caused some uncertainty and volatility. The compound inflation over the last several years has really impacted many consumers. In fact, it turns out that about 25% of Americans are now using buy now, pay later users to purchase groceries. This is a significant increase over the previous year of 2024. In fact, the survey goes on to state that 41% of respondents have had a late payment on their buy now, pay later loan that they used to purchase groceries. And this just demonstrates that some consumers are really having trouble affording the basic essentials, such as groceries. This has been caused by the high levels of inflation that have occurred over the last several years. Granted, inflation increases have come down significantly recently, but it's not the year-to-year total that's the key. It's the compound effect of inflation that's devastating. I've often used the analogy of if somebody gained 5 pounds one year, 10 pounds the next year, and 5 pounds the third year, you can't go and say, well, you just gained 5 pounds. You actually gained 20 pounds over the last 3 years, didn't you? You have to add the 5, the 10, and the 5. We have the same type of situation with inflation, particularly with grocery prices that are about 30% on average higher than they were 4 years ago. There is some hope with some of those prices coming down somewhat due to lower energy prices. Certainly that is helpful. But the trade uncertainty that is going on as we speak certainly is not going to help the situation, at least in the short run. Again, I'm in favor of what's going on in terms of trying to create more fair trade deals. I believe we'll see some significant improvement on that in the near future. Bringing back some manufacturing in the United States is a national security issue, among other things. But there will be some pain involved in the transition process, which may take longer than some people realize, and that's what Wall Street is really concerned about. And the biggest concern is China. I saw a study recently stating that 1/3 of all items made in the world are currently made in China. That is significant. A lot of what's going to happen here going forward really comes down to how is China going to react to this changing economic situation that we're facing right now. The best thing a person can do currently is protect the downside. reduce your market risk, increase your liquidity, put yourself in a position where you can take advantage of opportunities when they arise. If we see a downturn or a correction, you could then pull the trigger if your money is highly liquid, insured, guaranteed, is not subject to the losses that may occur during that time frame. Inevitably, they're going to occur. It's a matter of time. It's just what's the cause? What's the trigger? No one truly knows. Your personal bank is insured, guaranteed, income tax free, and highly liquid. It's a fantastic tool to reduce some of your market exposure, some of your risk, put yourself in a better position liquidity wise to take advantage of future opportunities when they do occur. If you want more information on this, contact me at yourpersonalbank.com. Stay tuned in the next segment. I've got some information about retirement that I think you'll find very interesting.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, that you will reach me. It's yourpersonalbank.com. A recent survey showed that Americans worry more about going broke in retirement than dying. I found that somewhat shocking, but not surprising. It turns out, according to this study, that 64% worry more about running out of money than death. 62% say they're not saving as much for retirement as they would like. And 54% say inflation contributes to their fear of running out of money. Now, this fact regarding inflation tends to strike a nerve more with retirees than younger generations. And it makes sense because many people who are retired are on a fixed income. Therefore, their ability for their dollar, their purchasing power to increase is diminished. Their ability to increase their income is diminished. So inflation hits retirees on fixed income far more than others. And the people that are concerned about running out of money in retirement have a valid concern. In fact, this MarketWatch article discusses living past 90 or even 100 will become more common. Are you ready for it? And as they state, the old rules about retirement may no longer apply. I can vouch for this. As many of you know, I'm in the life insurance business. We use high cash value insurance policies to maximize returns, grow your money insured, guaranteed, tax-free, highly liquid. We're maximizing cash values versus death benefit, which is the opposite purpose of how most people use insurance. This is how banks and institutional investors, wealthy families often invest and use to increase their returns, reduce their market risk, increase their tax-free income, that type of stuff, liquidity. But although we are maximizing cash values, cash growth, and reducing death benefits, there still is one. So there is a qualification procedure go through with most of my clients. Now, most of the requirements, because we're doing minimizing death benefit, to qualify, it's quite easy. In most cases, there's minimal, if no exams required in most cases. So all that's great. But due to the fact I deal with this, I see longevity tables, underwriting. I deal with this on a regular basis. And underwriters are uncannily accurate in terms of estimating longevity of an individual. I've been told by underwriters that if they have enough medical information and family history, they can literally predict almost to the month how long you will live with over a 98% accuracy rate. That's how accurate, it's a science. That's how accurate these insurance companies are in terms of longevity. And by the way, to dispel another myth, insurance companies want you to live longer versus shorter. The longer you live, the longer they have to invest the money you give them to make a return before they have to pay the death benefit. It's often a common misconception. They're actually betting for you. They want you to live a long time. They'll encourage you to do so. It benefits them and you. So they're on the same side, by the way. But as this Market Watch article, as I stated earlier, discusses the longevity, when I go through underwriting with a potential client and we review the numbers and we look at the longevity, how long they're likely going to live with, again, a 98% plus accuracy rate. It truly helps in planning, in retirement planning. It takes away a lot of the guesswork. It takes away a lot of the concern, the fears of this study stating the number one fear they have of running out of money before they run out of time. We can plan for that effectively. And this is the difference, by the way, of a distribution specialist like myself. Yes, we grow the money, but we also have a distribution plan versus a growth specialist. There's nothing against growth specialists and focus on growing your portfolio and your nest egg. But in 99% of the cases I see, there's really no clear plan on the distribution side in terms of how long is your money going to last, because you don't know how long you're going to live. With a pretty high degree of accuracy, I can help you determine that, which means you can plan your retirement far more accurately. And when I share these life expectancy probabilities with people, most are shocked when they find out how long they actually are likely going to live. In most cases, it's far longer than they anticipated, which means they have genuine fears about running out of money in retirement. It turns out today that if you're an adult male in good health, that you have over about a 65% chance of living to at least 85. Women have a 73% chance, adult women, of living to 85. So there's almost 3/4 of the adult women living today are going to live past age 85. And if you take a couple who are non-smokers currently in good health and adults, there's a 90% chance one of the couple are going to make it to 85 plus. This has a huge impact in retirement planning and determining how much money you're going to have and how long it's going to last. One of the other factors, and this is according to JP Morgan, is your withdrawal rate of your portfolio determines to a large degree if you're going to outlast your money or not. And it turns out the 4% withdrawal rate that we often hear about gives a person or a couple about an 85 to 90% probability of not running out of money. That's a pretty good percentage, but it's certainly not 100%. The lower your withdrawal rate, the higher you increase your likelihood of you not outliving your money. The higher the withdrawal rate, the likelihood of your money lasting drops dramatically. In fact, if you go from a 4% withdrawal rate to a 5% withdrawal rate, the likelihood of you not running out of money in retirement drops to anywhere from 50 to 75%. It's a significant drop from a 4% withdrawal rate to a 5% withdrawal rate. And if you go to 6%, you're well below 50% likelihood of success. In other words, you're going to run out of money before you run out of time. Now, what I find interesting about this is in a typical portfolio, whether it's a 60-40, 40-60, 50-50, whatever stock bond portfolio mix, is that we have guaranteed lifetime income riders that will increase upwards of 10% annual every year you defer. And many of them have a 7% plus withdrawal rate depending on your age. The older you are, the higher the withdrawal rate you can take. And the money's guaranteed to come in and you not outlive the money. I see as someone who's been in the financial world for over 25 years, worked with many, many retirees. A guaranteed lifetime income rider can alleviate a ton of the stress that over 2/3 of retirees currently have. By allocating a portion of their portfolio to this, could really minimize that risk and that concern and that stress, and can allow a much higher withdrawal rate than a typical portfolio or what's recommended from a typical portfolio. So not only can you receive more money, but it's guaranteed for the rest of your life, regardless of how long you live. Oftentimes, it's referred to, guaranteed lifetime income riders are referred to as longevity insurance. You cannot outlive this money. Very few people that I meet have these type of assets. This is the golden age of fixed assets. We're seeing some of the highest numbers we have seen in over 40 years. If you want to turn on your guaranteed income stream sooner, we have products that will pay up to a 30% signing bonus up front, and it'll increase 7-8% the first year. So you could start the income, say after 1 year, and increase the amount you would receive in income guaranteed for life by like 38%. That is a huge increase or bump up of asset value that you can then turn on an income stream that lasts the rest of your life, guaranteed. And every year you wait to turn it on, the more you'll receive. Some of my clients will even fund multiple ones of these where they'll turn one on initially. You can do it right away, 30 days. And then maybe have another one where they turn it on in a year or 2 or 5 or whatever makes sense. And sometimes even a third one. Maybe they're going to turn that one on in a decade from now, where it will increase upwards of 9-10% annually. If you defer that for a decade, you're going to have well over double the amount of money in that account guaranteed to then pay you income guaranteed for the rest of your life. Guaranteed income riders are a tremendous solution for anyone who's worried about going broke in retirement, which happens to be, according to this study, about 2/3 of Americans. So it gives you an idea of how significant this can be, and many, many more people, particularly those that are nearing or in retirement, should be looking at this option as a solution to alleviate that problem. And this is one of those few financial tools, by the way, that's better as you get older. The amount of income you receive is a combination of the monies you contribute, how long you defer, and your age. It's an actuarial calculation. Each year you get older, your life expectancy is shorter, so they'll pay you more. They'll pay you more guaranteed income. So as you get older, this benefits you. In the financial world, there's not many things out there that are better for folks that are older. You know what I'm saying? So if you want more information on this, I've been working with these for 25 years. We have the best numbers we've seen in 42 years. It's a golden age of fixed assets. Check it out. I can help you ensure that you will not run out of money. I can make sure you won't go broke in retirement. I can make sure you won't run out of money before you run out of time. Contact me at yourpersonalbank.com for more information. Stay tuned in the next segment. I got a couple other thoughts regarding the markets that I think you'll find very interesting.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. That's yourpersonalbank.com. So we're starting to see something that I haven't seen for a while, but is very familiar to me. Saw this in 08, 09. I saw it in the dot-com bubble burst. But as this AP article states, market turmoil has many afraid to check retirement savings. And they refer to this gentleman, and as he states, not wanting to get upset and question if he could retire in a few years, there's only one solution for him. He's not looking at his statements. And then he goes on to say, and I quote, "I hope like hell I don't lose all my retirement savings. But where else could I put the money?" He obviously has not listened to this show. And I don't mean to make light of his situation, but this is a very common scenario I run into, have over my career, particularly when the markets start to show volatility. When investors get fearful, when those nearing retirement or in retirement get to the point where they have anxiety, they have concerns, they have fear, they don't want to look at their statements even. I have a simple question. Is that how you want to live? Is that how you want to enjoy your golden years? Is this how you envisioned it? Is the stress of not knowing whether, as this gentleman said, his retirement savings are going to go away, is it worth it? Clearly, there are other options. There are guaranteed and insured options. It's the golden age of fixed assets. Your personal bank pays a 6% plus dividend currently, historically 7. Dividends are on their way up. Tax free. So depending on your tax bracket, for most Americans, that's 8 or 9% annual return after tax. That's powerful. Insured with guarantees. We have annuities that have protect the downside, no downside risk. There's IUL products that allow you double-digit returns on good market years when indexes go up and no market risk when indexes go down. The principal is guaranteed. I have clients that earn 20% plus returns in their index annuities and IULs in the past couple of years. The beauty of it is, if the market does correct and go backwards, they will not lose those gains. They lock in annually. It's like a stair-step approach to investing. Each year, as I state to people, you're going to have the same amount of money or more, but never less. Oftentimes, people get confused when they say, well, I don't want to get out of the market completely. Some may, others don't. It really depends on the situation. If somebody's stressing out and they're near or in retirement and they're really concerned, they may want to put majority, if not all of their money into safer options so they don't lose their nest egg, their portfolio, their retirement accounts. Others may want to put a portion in. One of the biggest mistakes I see most investors make, this is throughout my entire career, is they put, in essence, all their eggs in one basket. And what I mean by that is they typically are in the market, most, if not all, of their assets. Yes, they're diversified into different sectors and various things like that. But when you have a big market move, like we saw in 0809, like we saw in the dot-com era, as we're starting to see currently, we'll see what happens. For the most part, most of their assets in their portfolio move in the same direction. The analogy is a rising tide raises all ships, or lowering tide also tends to lower most all ships. So they're not truly diversified, and that term has been bastardized by Wall Street. Diversification used to mean you were diversified in uncorrelated assets. In other words, you might have had some assets in the stock market, you might have had some bonds or something else like that, fixed assets. You might have had some real estate. You might have had some precious metals. Maybe you had business income or something like that. You were truly diversifying your assets or your income. But most people that I meet with these days, easily 80, 90% plus, it's all in the market. Most, if not all of it, is all at risk. When you start asking them some questions, they don't even realize oftentimes how much risk they're truly taking on. And when I point out that these things could all be at risk, oftentimes they're not even aware of the fact, or as they'll often state to me, that's not what I really wanted. I want to at least have some of the money safe. Yet what they're actually invested in is completely the opposite of what they tell me they want to do. I point this out to them on their accounts, on their statements, various things that we look at. If you want to reduce your market risk, if you want to step away from some of the volatility, if you're concerned like this gentleman in this article where he's not looking, the solution to financial planning is not to ignore it, put your head in the sand and act like an ostrich. We call it ostrich syndrome, and just hope that things get better. That's not planning. That's not being proactive. That's called hopium. And sometimes that works out and sometimes it doesn't. But just to float down the river like you're in an inner tube, subject yourself to all the rapids and the rocks and the pitfalls without any effort to do anything otherwise is not wise financial planning, in my opinion. To be a little more proactive, to do something different, to reduce your risk, to take some active steps is far more beneficial in most situations. If you're concerned, if you're worried, if you are in a position where any kind of significant loss would be detrimental, particularly if you're nearing or in retirement, you really should take some steps to reduce your risk. And there's never been a better time in over 40 years to do it. That's the part of the equation I find shocking. We have these amazing tools available, yet we still have people out there saying, I don't know what else to do. Where else can I put my money? And I sure hope I don't lose it all. That's no way to go forward. Give yourself some options. Talk to somebody else that might have a different story or a different product available to you. And I often hear this, well, why did not my financial advisor recommend this to me? Please understand, financial advisors specialize just like most any other professions. Doctors famously specialize in their area of expertise. We have many financial advisors that focus in the growth arena. They're great at growing a nest egg, putting money at risk to get a return. And when things go well and the markets are good, that's great. But when volatility hits, as one of the articles I referred to a week or two ago, sometimes you need nerves of steel. Not everybody has those, or they're not in a position in their life where they can afford to lose, again, because maybe they're nearing retirement. And by the way, you may plan for retirement at, say, a certain age, but health or jobs or career reasons may force you to retire prematurely or earlier than you had planned. So having a plan B, having a contingency plan, reducing the risk, having some other options other than just putting it all in putting it all in one basket in the market, for example, might just make some sense. And that's the point I'm trying to say. I'm not trying to pick on anybody here. I'm trying to help you and get people to think and realize, you know what, there are some other options and maybe I should explore those or consider it or look into it, despite what I'm being told or what I've seen or what I'm hearing. Maybe other options might be better for my situation. Doing what the 95% do gets you what the 95% get. Sometimes you may want to consider what the 5% do, because then you might just get what the 5% get. Sometimes it's a different way of thinking. But if it reduces your stress, if it reduces your anxiety, if we can ensure that you don't run out of money in retirement, you don't run out of money before you run out of time, we can increase your income guaranteed for the rest of your life, you might want to consider or look at. And given it's the best time in over 40 years, it's the golden age of fixed assets, there's never been a better time to look at this. Doesn't it make sense to consider it? That's all I'm trying to say. If you haven't, contact me at yourpersonalbank.com. Or if you did look at this maybe a couple years ago or so, I'm going to tell you the numbers and the returns are vastly improved. And I'm talking about 2- and 3-fold better than they were 2-3 years ago. Again, because of the higher interest rates, the higher bond yields, the higher profits of these annuity and insurance companies. They have not seen better numbers in 40 plus years. If you haven't looked into this or you haven't looked into it in the last couple of years, you should do yourself a favor and do so. Contact me at yourpersonalbank.com for more information. Stay tuned in the last segment. I got a little bit more about the markets and how I have observed over my 25 plus year career how most people really grow wealth, not what Wall Street or the legacy media wants to tell you. Stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Now, I found this Business Insider article fascinating. The title is, I spent the entire weekend at a tech investment banking conference, and there was a sense of disbelief that Trump has been so bad for Wall Street. Now, my response to this immediately was, wow, these people are out of touch. If they had just paid attention to any of the campaign rallies that Trump did, the things that he promised and stated he would do, even those that are against Trump reluctantly admit to the fact that he's doing what he said he would do on the campaign trail. Some of them seem shocked by that, and I guess it's because so many politicians for decades have promised us so many things and often do little or nothing or do the opposite even, oftentimes of what they promised on the campaign trail. What they don't understand about Trump is he's not a politician. He's a businessman. Business people tend to do what they say they're going to do. If they don't, they don't succeed in business. That's part of the appeal that many of these elites can't seem to understand. Again, they're in their bubble and they're not in the real world, not paying attention to what's really going on. As this investment banking conference referred to with bankers and venture capitalists, the report had discussed they were eager to talk to anyone who could provide some insight about Trump's trade war. And they were hoping that deal making and IPOs would roar back to life, which they didn't, because no one really knows how long this uncertainty will last regarding tariffs. And as the Trump administration themselves have stated, that tariffs will inflict short-term pain, they expect them to result in greater long-term prosperity. The Trump administration is embarking on what Ray Dalio states is a once-in-a-generation economic shift. And as he states, it threatens the existing world order. He's correct in that. The shipping of manufacturing jobs off to China to produce items cheaply is for the most part over. The reliance on China to produce much, if not all, of what we need or use, those days are behind us. And if that's a surprise to you, again, you weren't paying attention to what's really going on. You weren't listening to what Trump was actually saying. I understand he can be bombastic. He's a New York businessman. He comes from that world of real estate development where they often embellish and they talk about a project and they have to sell investors and bankers and buyers of these projects, and they talk about how grand and how awesome this is going to be. That's part of the process of being successful as a big city real estate developer. And that's Trump to a T. So yes, some of the stuff he says is bombastic and he embellishes. But if you really listen, he's still a businessman and he tends to follow through on what he says he's going to do. Just look at his first administration. He did the same thing then for the most part, or at least did his level best. As these investment bankers were saying, there's a little bit of disbelief. They thought the tariff talk was some rabble-rousing. I didn't. Neither did most people who were paying attention and most who voted for him. That's why you're seeing the legacy media parroting this statement of, how Trump voters are regretting, their vote. No, they're not. Polls have shown that. Very, very few do. They wanted to see disruption. They wanted to see a change in the status quo because what might have been working for these investment bankers was not working for the average American. I've talked about this on this show. Go anywhere to a rural area or small town, and just about anywhere in America, and you see economic devastation for the most part. You see small towns that are a hollow shell of what they used to be just a few decades ago. And that's half of America, folks. And those people wanted change, and that's what they voted for. In essence, they voted for a turnaround CEO. That's what Trump is doing. He's overturning decades of economic policy, free trade, which wasn't really free, it turns out. Most countries were taking tremendous advantage of us as a country, instituting tremendous tariff levels while we had little or none for them. But until this decoupling between the U.S. and China is more or less settled, we're going to see transition. That's the bottom line. We're going to see volatility. That's why, according to J.P. Morgan, hedge funds, not foreign investors, are the ones that have been dumping stocks. The foreign investors seem to be hanging in there because they still see the U.S. as a safe haven, despite all the tariff activity and what's going on. Again, primarily, the tariff policies with every country in the world outside of China is likely fairly well settled. They're working on the details. We're going to start seeing many of these deals, I believe, soon. Most likely, many of these cases will be a 10% tariff going both ways, which will be a tremendous improvement for the United States in most cases and would be tremendously beneficial and not disruptive. China is another story, as I've stated. But the last thought I want to get to is this. I often get asked about how to earn more money, how to build wealth. People know I've been around working with people with money for over 25 years. Nearly 3/4 of my clients are entrepreneurs. Majority of the rest of those happen to be professionals, but I have average everyday folks too. When you see these get rich quick schemes online, and for the most part, that's not how most people made their money. Most cases, I hate to say this, but most people don't invest early. What they do is they control their income first. See, it's difficult for young people to think 20, 30, 40 years down the road. You know what I'm talking about. If you think back when you were younger, if you're not so young today, you know what I'm talking about. You're not thinking about retirement in your 20s and 30s. You're thinking about who you're going to go out with this weekend or what party you're going to. So to get someone like that to be disciplined, to put something away for the future, is extraordinarily difficult. There are exceptions. I have some clients that are young and even in late teens, early 20s, who have done some of that and are doing tremendous. But in most cases, their parents were the ones that took the lead and gave them the advice and direction so that they could be more successful. But outside of that, you don't see that. What it comes down to is most people earlier in their career or even mid or later learn to increase their income, whether it's through earning a high income in a profession or generating cash flow with a business. It's tough to save your way to real wealth on a small salary. It's much easier to save and invest when you're making serious money. One of the things I do with many of my clients, and I dealt with one of those just today, where he's looking at selling a real estate asset so he can generate some money to expand his business, open another location. He has a successful, profitable business. He's determined how he can expand that into multiple locations, manage that effectively. And as I stated to him, if you have a business process that works, one of the best things you can do is wash, rinse, and repeat. Your economic engine as an entrepreneur is your business, the business income and profits that you can make. And even if you're not so young, oftentimes you can really generate increased income through expanding your business if you have something successful. Now, what I also find is most entrepreneurs and professionals for that matter, folks that have a strong income, those that do well financially don't risk it on the next big thing. They're not trading, they're not trading crypto and all that. They're investing it in boring, consistent things. In other words, they took a risk on themselves in developing an income or their business, and the last thing they're looking to do is risk it again in investments. They want consistent, steady results, especially if you're a business owner. You want liquidity, access to the money, because businesses have cash flow needs. And another key point I find is the wealthy really focus far more on protecting their downside than chasing the upside. They're more concerned about, instead of how do I make the most money possible, they're thinking, how do I make sure I don't lose it? They protect at least a portion of their assets or their portfolio. Again, your personal bank, annuities, tools like that come in strong for that. Also, wealthy people tend to have a longer time frame in their thinking. They often think in terms of decades, not months or quarters. Instead of thinking about quarterly returns or annual returns, they're thinking about the next 5, 10, 20 years. It's a far more effective way to go and far more successful. A wealthy or successful person will ask me, what does this asset look like in 10 or 20 years from now? Not next year. In fact, the study showed recently that the average person holds an asset for 4 years. That's far too short of a period of time to truly expect results consistently. These are a few of the key things I find with wealthy individuals, successful individuals. The more you emulate those, the more you're likely going to succeed. One of my great joys of what I do, being an entrepreneur of over 30 years of 4 different businesses myself, I understand businesses. So I enjoy problem solving or bouncing ideas off and helping business owners and entrepreneurs expand their businesses, increase their cash flows, reduce their expenses, become more profitable. Your personal bank is one of the great tools to accomplish that, to increase their overall return. We typically increase overall returns from 10 to 20%. Net profit, top line profit. You give me any business and improves its profitability by 10 to 20%, I'll show you a profitable business in most cases. If you want more information, contact me at yourpersonalbank.com. Love to talk to you. Stay tuned next week for more great information on the Your Personal Bank Show, and as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.